Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of business. Today we are diving into the world of the Federal Home Loan Bank of Indianapolis, and trust me, even though it sounds like a snooze fest, their latest filing has some interesting details about bonds that could affect pretty much anyone who has a mortgage. It's all about where banks get the money to lend to you. This is a Form AK, which is basically a snapshot of important events that a company needs to tell the Securities and Exchange Commission about. Think of it as a financial bat signal. In this case, the alert is about new debt. Specifically, it's about the creation of some direct financial obligations, which in plain English means they're taking on new debt by issuing bonds. These bonds are called consolidated obligation bonds, and they're issued by a bunch of federal home loan banks together. It's kind of like a group project, but with trillions of dollars. Now, let's get to the numbers. The filing shows a few bonds that were issued. One was traded on April 7, 2025 and will settle or officially be issued a week later on April 14th. It will mature in 2027, meaning it will be paid back then. The coupon or interest rate isn't listed, but the total amount is $250 million. The other bond was traded the next day. This one is for a much smaller amount of only $1 million. So what does this all mean? Basically, the Federal Home Loan Bank of Indianapolis is borrowing money. They are going to use this money to fund loans to their member banks, who then turn around and lend that money to people like you and me for things like mortgages. The interest rates on these bonds influence the interest rates on everything else. These bonds have different features, with one having an optional principal redemption, meaning that the bank has the RVA to pay them back earlier, and other having a non-callable feature, so that they can't be called or they can't be paid back early. It's important to note that these bonds are joint and several obligations of all the federal home loan banks. It's like a financial safety net. The filing also states that these obligations are not guaranteed by the US government. It's up to these banks to handle it themselves. All of this was signed off by Lana D. Buchman, Associate Director of Financial Reporting, on April 10, 25. So this is not future planning. This already happened. Now, let's step back and see what this tells us about the Federal Home Loan Bank of Indianapolis and, frankly, about the housing market in general. Direction-wise, it's clear they're continuing to actively participate in the market, issuing debt to support lending. It appears they're bullish, or in simple terms, they think things are going to go well and housing rates will stay high. Issuing these bonds shows they anticipate a continued need for funds to lend to their members. One notable opportunity is the potential to capitalize on favorable interest rate environments. If rates stay low or decrease, they can lock in cheaper funding for future lending. Now, for risks, this all depends on how well these loans perform. The biggest risk is that people might stop paying back their loans and then the banks won't have enough to pay back the bonds. That's bad for everyone. We don't see any specific risks in this filing, but that's a general thing with any large lending operation. In conclusion, while this filing is pretty straightforward, it provides a small glimpse into the machinery that keeps the mortgage market running. It's a reminder that behind every home loan is a complex web of financial transactions, and the federal home loan banks play a big role in making it all happen. Thanks for watching Corporate Decoder. If you found this breakdown helpful, give us a like, drop a comment, and definitely subscribe so you don't miss our next deep dive into the world of corporate filings. Until then, stay informed and stay curious.